You know that classic American advice, just buy the S&P 500, you'll be set for life, yeah? If you live in Europe, that can actually hurt your investments and nobody talks about it. In this video, I'll show you two of the biggest traps European investors fall into, the S&P 500 trap and the currency trap, and how to avoid losing money without even realizing it. So today we'll cover one, why the S&P 500 is not diversification. Two, why even global ETFs are secretly USA heavy. Three, how currency movements can eat your returns. Four, what European investors can do differently simply. I'm Francesca, ex-investment banker, turned financial educator and founder of Centsational Women, the leading investing education brand for women in Europe. So let's start with the S&P 500, the sacred cow of American investing. In the US, it's often sold as buy the S&P 500 and forget about it. But for European investors, it's like saying your entire wardrobe should be, let's say, Zara. It's cute, but not exactly diversified because, here's the truth. Even though the S&P 500 technically has 500 companies, it's basically one outfit repeated over and over. Same country, same currency, same mega tech vibes. And even outside the S&P, most global ETFs are the same story. So you think you're investing globally, and then discover the portfolio is 60% US, 20% tech, and 10% vibes. That means you're not diversified geographically. You're overexposed to one market. You're betting on the US without realizing it. And look, I love the US, but we live in Europe. Our careers, retirement, taxes, spending, and currencies are all European. Our investments should reflect our reality, not America's. Here's what most Europeans get blindsided. You buy an ETF, it goes up, you're feeling amazing. Then you check your returns in euros and they're lower or even negative. Why? Because the currency moved. If the euro gets stronger against the dollar, your US investments lose value when converted back into euros, even if the ETF itself performed well. This is why Americans never talk about currency risk. They invest in their own currency. We don't. So if this already feels clearer than anything you've heard before, pause for a second and hit subscribe. We make money simple here. So what can we do? You have two tools. One, currency hedged ETFs. These protect you from big euro-dollar swings. Not always a necessary, but incredibly useful depending on the assets and on your time horizon. And then accumulating ETFs. In many European countries, they are more tax efficient than distributing ETFs. Not everywhere, but in most cases, they simplify your life. So the point here is that as Europeans, we need to consider things Americans never think about because their system is not our system. So the goal is not to avoid US stocks. The goal is to avoid an accidental all-American portfolio, to be overexposed to the US. So instead of blindly copying US influencers, think in terms of your currency, your country's tax laws, your long-term currency exposure, real diversification across multiple regions, simple ETFs that fit your actual life. So this is how you protect yourself from stocks, stay consistent, and build long-term wealth without drama. So here's your takeaway for today. Your ETF can go up, but you can still lose money when the euro strengthens against the dollar. Then currency hedge ETFs will protect you from that. And accumulating ETFs can save you taxes depending on your country. The big lesson, you don't need more products. You need the right products for your reality. So if this helps you, top like, so more European women get access to information that actually fits their life. And if you want clarity on choosing ETFs, currency hedging, or building a simple diversified portfolio, my free workshop is linked below. So stay powerful, stay soft, and as always, stay sensational.